Every financial collapse has its prophets. They sit on television panels. They smile from magazine covers. They headline conferences. They write best-selling books. They speak with certainty. They reassure nervous investors that the system is stable, that the opportunity is historic, that skeptics simply don't understand the new era unfolding before them. And when the dust finally settles, those same voices remain the most confident and the most wrong. Welcome to the Financial Historian, where money, power, and human psychology collide. And nothing is ever as simple as it seems. This is not a story about stupidity. It's not about reckless gamblers chasing fantasy profits. Many of the people who trusted the wrong gurus were intelligent, educated, analytical, wealthy. Pension funds trusted them. Universities trusted them. Regulators trusted them. So the real question isn't who was foolish. The real question is harder. Why do intelligent people repeatedly trust confident people who fail spectacularly? Let's go back. The late 1990s. The internet revolution. The world was changing. The internet promised to rewrite commerce, communication, everything. Companies with no profits went public and doubled on their first day. The NASDAQ composite rose nearly 400% between 1995 and March 2000. It didn't look like speculation. It felt like destiny. And every destiny needs interpreters. Wall Street analysts became celebrities. One of the most visible was Henry Blodgett. In 1998, he predicted Amazon would hit $400, a bold forecast at the time. When it happened, he became a symbol of new economy brilliance. Investors didn't just want data. They wanted conviction. Later, internal emails revealed something uncomfortable. Stocks publicly rated as strong buys were privately described as junk, but the system rewarded optimism. Investment banks earned massive IPO fees. Excitement drove deal flow. Caution did not. Then, in 2000, the bubble burst. Between March 2000 and October 2002, the NASDAQ fell 78%. Trillions vanished. Retirement accounts collapsed. Startups evaporated. In 2003, Blodgett was permanently barred from the securities industry. The narrative had been powerful. The incentives had aligned with enthusiasm. And investors believed the confident voices. Stability as seduction, the Madoff illusion. If the dot-com era sold optimism, Bernie Madoff sold stability. He wasn't loud. He didn't promise 10x returns. He promised something more seductive, consistency, roughly 10 to 12% annually, year after year, regardless of market chaos. He had credibility. Former chairman of NASDAQ, deep Wall Street connections, elite investors. He didn't sell greed. He sold relief. And in uncertain markets, relief is intoxicating. In December 2008, amid the collapse of Lehman Brothers, his $65 billion Ponzi scheme was exposed, the largest in history. The shock wasn't just financial. It was psychological. Sophisticated investors hadn't chased impossible returns. They had trusted a calm authority figure. Authority bias is powerful. Scarcity increases legitimacy. Silence implies sophistication. But the illusion depended on one thing: new money covering old promises. When confidence cracked, the structure imploded. Housing, the illusion of permanence. Now shift to housing. Between 1997 and 2006, U.S. home prices nearly doubled. Mortgage lending exploded. Mortgage-backed securities and collateralized debt obligations were engineered and sold globally. The narrative was simple. Housing prices don't fall nationally. It sounded intuitive. People need homes. Demographics support demand. Models assume stability. Incentives encourage volume, not caution. From 2006 to 2012, U.S. home prices fell roughly 27%. Foreclosures surged. Credit markets froze. The worst global recession since the 1930s unfolded. The housing gurus weren't cartoon villains. Many genuinely believed the models. But belief and truth are different currencies. Crypto, certainty, and a hoodie. Fast forward to 2020 to 2021. A new generation of confident voices emerged, amplified by podcasts, YouTube, venture capital branding. Cryptocurrency soared. NFTs sold for millions. And then came Sam Bankman-Fried, a quantitative trader turned crypto exchange founder. Hoodie, disheveled hair, calm talk of effective altruism. Venture capital giants invested billions. Politicians accepted donations. Media crowned him a genius. In November 2022, his exchange collapsed. Billions vanished. Institutions had endorsed him. Investors trusted the narrative. Authority bias merged with technological mystique. Different era, same structure. The pattern. .com profits. Stable return insiders. Housing cheerleaders. Crypto prodigies. Each cycle had warning signs. Valuations detached from cash flows. Opaque strategies. Hidden leverage. But the dominant voices projected certainty. And certainty is magnetic. Here's the uncomfortable truth. We don't trust the wrong gurus because information is unavailable. In most of these episodes, the data existed. Skeptics published counterarguments. Journalists raised concerns. We trust them because certainty feels safer than ambiguity. Financial markets are probabilistic systems. True expertise speaks in ranges, probabilities, risk scenarios, but probability sounds hesitant. Hesitation doesn't inspire confidence. The opportunity of a generation always outperforms. There is a high likelihood of volatility given leverage ratios. Confidence signals leadership. In uncertain environments, humans gravitate toward decisiveness, and the financial system rewards that trait, at least in the short term. Media platforms elevate bold claims. Banks benefit from bullish narratives. Influencers gain followers through clarity, not nuance. If there were a gold medal for financial certainty, it would be awarded before the crash, not after. By the time the cycle turns, the guru's certainty has already done its work. Capital has been allocated, risk has been concentrated, leverage has been built, and when correction arrives, it doesn't just erase wealth. It reveals how deeply we wanted to believe. The reason we keep trusting the wrong gurus is not because we are foolish. It's because the system is designed to reward them. For a while, let's begin with something uncomfortable. Authority bias, one of the most documented tendencies in human psychology. We assign disproportionate credibility to people who signal status, credentials, institutional backing, elite networks, exclusive access. In finance, those signals are amplified. A former exchange chairman, a star analyst at a major investment bank, a venture-backed founder on the cover of Forbes. We assume access equals insight, but access often equals alignment. Bernie Madoff didn't just appear successful. He was embedded in the system. That embedding reduced friction. Investors reasoned. If regulators interact with him, if major funds allocate capital to him, if respected peers endorse him, the risk must be low. Authority becomes self-reinforcing. And then comes social proof. Humans are herd-oriented. When everyone around you appears confident, skepticism feels socially expensive. During the housing boom, neighbors refinanced. Banks approved loans easily. Media narratives reinforced optimism. Questioning the trend felt irrational. In 2021, when crypto prices climbed daily and celebrities endorsed exchanges, hesitation felt like failure. Fear of missing out isn't greed. It's social survival. The quiet engine, incentive misalignment. Now look beneath the surface. During the dot-com era, analysts weren't paid primarily to be right over decades. They were paid to generate excitement. Investment banks earned underwriting fees. A bearish analyst does not attract IPO mandates. Mortgage originators in the 2000s were compensated for loan volume, not durability. Rating agencies were paid by the issuers whose products they rated. Venture capital benefits from narrative momentum. Influencers benefit from engagement. Media outlets benefit from bold headlines. Confidence sells. Caution stalls. Modern finance is short-term optimized. Quarterly earnings. Performance metrics. Fund inflows. Subscriber growth. If a guru's bold claim attracts capital today, the system rewards them today. If the collapse comes years later, that consequence arrives after bonuses are paid and reputations are monetized. Nothing says aligned incentives like being paid before the risk materializes. the seduction of simple stories. Financial systems are nonlinear and deeply interconnected. Monetary policy, inflation expectations, global capital flows, demographics, technology. True expertise often sounds uncertain because it acknowledges complexity. But uncertainty is uncomfortable. A simple story is efficient. The internet changes everything. Housing always goes up. Crypto replaces banks. AI will dominate productivity. Simple narratives reduce mental strain. They offer coherence in chaos. And coherence feels like control. When markets turn volatile, people don't want probability distributions. They want clarity. The brain prefers a flawed story to no story at all. Emotional timing. Financial gurus rise during instability. The late 1990s brought technological acceleration. The mid-2000s brought financial engineering and liquidity expansion. The post-2020 era brought pandemic shock and unprecedented stimulus. Traditional anchors weaken. Old models feel outdated. In those environments, bold interpreters flourish. The audience isn't irrational. It's anxious, and anxiety looks for leadership. The paradox of liquidity. Here's the deeper paradox. During boom phases, gurus often appear correct. Why? Liquidity is abundant. Credit expands. Central banks ease policy. Asset prices rise. Optimism becomes self-validating. Investors interpret rising prices as proof of insight, but price appreciation does not equal structural soundness. When monetary conditions tighten, when rates rise, credit contracts or shocks hit, fragility surfaces, leverage unwinds, overvalued assets reprice. The narrative collapses under arithmetic pressure. By then, capital has already been concentrated, and the damage is done. The modern amplifier. Now add social media. Algorithms reward engagement. Engagement is driven by emotion, surprise, outrage, hope, fear. Nuanced explanations rarely trend. Bold certainty does. A confident voice claiming an asset cannot fail spreads faster than a cautious analyst outlining risk scenarios. Follower counts translate into perceived credibility. Revenue streams, sponsorships, courses, affiliate links depend on audience growth. Financial education now competes with entertainment, and entertainment rewards certainty. Visibility becomes confused with expertise. Repetition breeds familiarity. Familiarity breeds trust. Meanwhile, genuine uncertainty is framed as weakness. An analyst revising forecasts cautiously seems inconsistent. A guru doubling down appears resolute. We admire conviction, even when it detaches from evidence. When belief becomes identity, there's another layer. Identity. When investors commit to a narrative, it becomes personal. They aren't just holding an asset. They're part of a movement, a revolution, a new era. Criticism of the asset becomes criticism of the self. Cognitive dissonance kicks in. Contrary evidence is dismissed. Communities defend their profits because abandoning them feels like abandoning belonging. Markets are financial systems, but they are also social systems, and social systems protect cohesion. What this means for you. The danger isn't only fraud. It's overconfidence wrapped in credibility. It's narrative replacing probability. It's incentives rewarding short-term certainty over long-term resilience. Financial education is not about finding the right guru. It's about understanding the system well enough that you don't need one. Markets will always produce confident voices. Some will be lucky, some insightful for a time, a few exceptional, but none eliminate uncertainty. History shows prediction is fragile. Preparation is durable. Preparation means diversification, risk management, skepticism toward absolutes, awareness of incentives. It means asking not just what is being promised, but who benefits if I believe this? Every generation believes it has finally found the right profit. Every generation eventually rediscovers that markets remain uncertain, leverage remains dangerous, and human psychology remains constant. The system doesn't collapse because gurus speak. It collapses because we outsource judgment. History doesn't repeat, but the pattern of confidence, amplification, and collapse keeps returning in new costumes. The names change, the platforms evolve, the incentives adapt, the psychology stays the same. If you want protection in volatile times, don't look for certainty. Look for structure. Look for incentives. Look for probabilities. The loudest voice in the room is rarely the safest guide. If this gave you a new perspective, subscribe. History has the answers. I'll show you where to look. Fire.